Hey, Jess.
Hello.
I heard through the grapevine being your TikTok, that CPI is cooling off, which means inflation is trending closer to the Fed's target, which means a rate cut may be in our future.
Emphasis on the may. Yes. Yes, that's accurate. I love this, Jesse. A funny thing also happened to me at the beginning of the week. I did a special on the Schwab Network. It's 28 minutes long. We actually will put a link in the show notes because it's really good.
It's that long. Wow.
It was. But they mentioned my TikTok, and she asked me about my TikTok being female in finance as well as overall market mechanics. So it's a really great episode. But I had no idea when I watched it back that my TikTok was on there. So my world's collided.
No.
I can't see what's on the screen. You're just staring into the void.
Mm-hmm.
So I don't know what that means, but I was watching it back. I'm like, oh, that's my house.
Yes, all the worlds colliding. The timelines intermersing.
Yeah, they are. Interest rates. This means interest rates are highly likely to come down. And I know we talked about that earlier on, about how to build a CD ladder and lock in those interest rates before the Fed cuts. But now there's more data behind this. So definitely good topic.
Well, I think that means it's time we talk about the market, the bond market.
Ooh.
Where I think we need martinis for this episode. Where are they? Where's the martini?
I would love someone to bring me a blue cheese stuffed olive dirty martini with some Belvedere.
Yes.
It's very specific.
That sounds delightful.
Yes, the bond market has been shaken. Even though I prefer it start. Which means it's a great time to talk about bond funds. We've talked about them. Yeah.
Discuss, shall we?
Here we go. Ding, 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 ding.
You're listening to Market MakeHer, the self-directed stock market and bond market education podcast that demystifies how investing works from her perspective.
We're your hosts. I'm Jessica and Skip, your Fin mom, mother, not sister, not friend, mother. I'm trying to own this. We'll get there. Thank you. Almost 15 years. Next month, we're going to call it July 9th. Here to explain how it all works.
And I'm Jessie Denuy, your Queerdo auntie. Happy Pride Month, by the way. Here to help Jess make it all make sense by asking all the questions and stopping her when she talks that jargon land talk.
And Taylor Swift talk, because I didn't write the intro today.
So I wrote intro, no Taylor Swift references today.
It's her 100th anniversary for the Eras Tour. 100th show.
Like that witch. She's been around hundreds of years. I didn't even realize.
Oh, I thought you'd find this fun, by the way. On June 21st, we have a quadruple witching on the market.
What does that mean?
So that means the 4 different derivatives securities instruments are all expiring on the same day. And so remember how we talked about gamma squeeze a little bit? It just creates a lot of activity in the market. It's interesting. June 21st.
That's also the summer solstice, as well as the strawberry full moon, which is our annual exciting meeting.
It is. A fun fact, we refuse to call it board meeting. Yeah. It's an exciting meeting.
Boring.
Does. Welcome to the Market Maker podcast. All right.
Okay, so apparently there is not only a stock market, there is also a bond market. So where do we begin?
All right. So, more teasers here. This is important. Before we begin, we need our listeners to know a few things. One, you cannot time the market. I don't know when the Fed will cut interest rates. They give us something called the SEP, or the dot plot, which is the series of economic projections, so we can get insight, get an indication, pay attention to our surroundings. We can't time. We don't know when they are going to, but we can prepare. We can understand when it's likely. So we are deeming it as highly likely, as is a lot of market participants, hence today's episode. 2, we are not financial advisors. Even though I was previously registered as one, I am not right now. I don't know your personal situation. Investing is personal. This is not that. 3, we're here for educational and informational purposes only. All right, now that we got that out of the way, here's the fun stuff. So I think we should talk about what happened. And I don't think we defined the SEP or the dot plot.
We talked about the dot plot in one of our episodes where we did like a FOMC meeting update, but we haven't talked about the SEP.
So the SEP and the dot plot, synonymous, same thing.
Oh. And that, see, I didn't realize that.
That series of economic projections. And it's called the dot plot because in finance, they're not creative. It's a survey of the whole committee, and they have where they feel different economic indicators are going to be by the end of the year, the next year, and the long run. So I included a link if you want to look at it. And if you go to page dos or 2, I don't know why I said dos, but it just gives you the change in GDP. So where do they feel growth is going to be?
Okay.
They feel like growth is going to slow down, which is interesting. The unemployment rate is going to tick a little bit higher. PCE, which is their preferred gauge for inflation, is going to move down naturally. And core PCE, which I found this one interesting. Right now, core PCE is at 2.7. And they expect it to be at 2.8 by the end of the year. So ticking up. Isn't that odd? I thought that was so odd. That was a question at the Fed meeting and by Steve Leisman, actually, which is the best person to watch with all of the Fed decisions. And he's like, what are you saying here? And Powell, he just didn't speak with as much conviction this time. It's really interesting because, I watched those like crazy. There wasn't like, yeah, this is going to happen. It's like he was surprised from all the data that we got because we got the CPI data that morning and it was lower. We got PPI this morning and it was a lot lower. And he gets that information before they made these decisions, before the committee put where they all feel these are going to be. So meaning all of that culminated together because they look at the totality of data. They'll tell you that the SCP and the dot plot is a projection, but it's not a plan. It's just, this is where we think it's going to be. And they change it as soon as new data comes in. Right. But they got this data beforehand and he seemed perplexed.
Oh.
Which means rate cuts just feel more likely, especially because of what we've been talking about, how there are cutting prices at Starbucks and Target, and all of that's going to come in to this data at some point.
Yeah.
Because this is lagging, whereas earnings are a little more real time.
These companies have been essentially price gouging us, are like, oh, people aren't shopping as much anymore, or whatever, and now they're actually going to cut the prices back, hopefully.
Yeah.
But
that is inflation, though, is price gouging. It's as high as consumers are willing to pay is what they will charge.
Always.
Yeah. Sad world.
Greedy.
It is. It's all about greed.
Yeah.
All right. But if there's indications that the Fed is going to cut rates, and remember, they do it for one or two reasons. One, beat the battle on inflation. Or two, do you remember number 2, Jesse? Just putting you on the spot.
Employment. No, wait.
That'd be a reason, actually, that a sudden tick.
There are 2 band-aids, right?
Yeah, if there was
and unemployment.
Yeah, if there was a sudden rise in unemployment, he said that directly that he would. So in response to recession, if they tip us into a recession, if there's cracks in the economy, but that actually is, I'm going to say that's a correct answer. Like if I was grading a test, I would say yes. There is no test.
Life is a test.
Well, yeah. I mean, it is. But we don't know why, though. But we can prepare and we can get insight from the people who are making the decisions. Yes.
Once they said a couple meetings ago they project 3 rate cuts this year, does that mean they have to do it, or can they change their mind anytime? Okay.
They change their mind, and they do based on the incoming data.
Right. So did they say anything about that now? Are they still talking about cutting rates, or we still don't really know?
It's one cut by the end of the year based on the dot plot if you go through all of this. But that may change.
To one cut. Right.
Yeah. That may change because of PPI, though. It changes all the time.
So PPI was higher?
Well, lower.
Lower. So PPI was lower. And as a result, we think that the Fed might cut rates sooner.
Yep.
Which means, as we've been saying, that your high yield savings rate rates are going to drop as well when the rates drop. So that means it's a good time to look at bonds again, like we've been talking about. And we have talked about CD ladders, but we haven't talked about like bond funds. So I think we're going to kind of talk about different ways you can lock in bond rates before those prices or those rates get dropped by the Fed, right?
Absolutely. So there is the jargon for this is it's time to add duration to your portfolio.
Oh, duration
risk. I feel like we should just have a jingle. Today's term is duration.
What is duration?
Duration, as by Investopedia, is a measure of the sensitivity of the price of a bond or other debt instrument to a change in interest rates. In other words, we're going to add duration to your portfolio. We're going to add longer-term fixed income products because there's going to be changes in interest rates. It's also a risk. So many things.
So it's a way to add a little bit more low risk or no risk investment to your portfolio.
That's right.
Of economic change.
That's right. Which is now times of economic change. Really is.
Change.
They do. All right. So there are different ways to lock in rates on your portfolio. We've talked about a lot of them, but this is another puzzle piece episode where everything should make sense if you listen to us all the way through. One, CDs. You can define CDs if you'd like, Jesse.
A CD is I was about to say compact disc.
It is.
Where's my brain? A CD is a certificate of deposit, right? Yes. So it's a way to lock up your money in a little cage for a set amount of time, and in return you get some interest back from whichever place you gave that money to and locked it up at the end of that amount of time.
Right. Normally issued by a bank. Got it. Treasuries. This is a debt instrument issued by the government. So the government has to fund our deficits. The way that they do that is via the Treasury market. They auction off these Treasury securities. They have different maturities. They can be 3 months, 6 months, 1 year, 10 year. Normally, the longer duration, the longer time frame, the higher the yield. But right now we have an inverted yield curve. So the shorter term durations have higher yields. And that's because we expect the economy to decline. You can look at that in the yield curve. Nonetheless, it's a way that you can lock in interest rates. And shorter term interest rates are higher because of the Fed's actions. I always give a longer definition.
And the yield is just like the money you make back on the money you are, putting in. So it's like an interest rate basically that you get back. That's your yield. And
exactly.
People like to buy U.S. Treasuries because so far the U.S. always pays its debts. So it's a very safe investment.
They're the Lannisters. It's called the risk-free rate. I have air quotes if you're not watching on video. Doing that with my fingers. Mm-hmm. And then there are bonds. I don't think we've talked about municipal bonds. We're going to introduce that today. All right. And there are corporate bonds, and we've talked about that briefly. Corporate bonds are the debt issued by companies. So like Apple, you can buy Apple's corporate bonds if you want. They want to finance their cool new AI that they released. They could do that via issuing debt securities. So there you go. Municipal bonds are just in the name, municipalities issuing debt. So, when you go on like the toll roads all in Florida, those are a type of bonds that's paid for with the tolls.
Right.
So they issue the debt in order to pay for the roads and stuff or whatever they're doing within the government. And then you can literally buy your county's debt if you want.
And that's a municipality debt.
That's right. Municipal bond is what that's called.
So it's just like more at a local level.
That's right.
Okay.
That's it. Remember, we talked about the risk scale. CD is going to be lower risk. Treasury is going to be slightly higher, still super low. Municipal is going to be still super low, but super higher. Corporate bonds, higher. But you want to make sure everything is investment grade. And there is a ratings guide that we can give you. But you want to look for investment grade. Normally when you go through your brokerage firm, and I think we'll do that today, you can see what the rating is. Companies have a credit rating. just like you and I have a credit rating. I saw a TikTok where somebody was like, I'm paying my taxes. Like, what's your credit rating? I meant to stitch it and be like, well, they were like, the government doesn't have one. I was like, yes, they do, actually.
Yes, they do. All the episodes where we've talked about all these things.
We do. There's so much linking that's going to happen here.
Yeah. Good covered up.
But investing in these individual securities can be very tedious, just like investing in the stock market and picking stocks can be tedious. And the solution to this is a fund.
A bond fund.
A bond fund.
Which I never knew existed until this podcast. I literally was like, oh, it's just stocks. And then I'm like, no, there's more than stocks. And there's also more than the stock market, bond market, all the different markets. But we're only talking about bond market today. I will not derail us. Let us talk about bond funds.
There is more than the stock and the bond market. That's all. I'll leave it there.
Said I'm not going to derail us.
Yes. So instead of going through an individual security, I wanted to link in iShares website. Not sponsored, just brought this up because I like the way that they have it put together.
We haven't looked at them yet.
But I linked in their iBonds. They have something called Ibond ETFs. They have a bunch of bonds with similar maturity dates in there. So if you wanted to create a bond ladder, even with Treasuries, you could use these. Or if you want to lock in short-term rates, you can use these. Instead of it being diversified with different maturities, it's very specific maturities. That's Ibond ETFs by iShares.
Okay.
So if you scroll to the bottom, you can see all of them there. And they have everything that we just discussed.
So iShares iBonds ETF lineup is what you're looking at?
Yes.
Okay. How do we look at this and know like how to decipher what we would want to purchase?
So I like the way they lay this out. They have the year, which is going to be the maturity, basically. So on the left-hand side, they've got U.S. Treasuries, U.S. TIPS, which is Treasury inflation-protected securities.
Oh. Municipals, which we just talked about. And then investment-grade corporate bonds.
That's right. So we talked about investment grade. Those are corporate bonds. High yield, also known as junk bonds.
Really? Why are they called junk bonds?
Because they are not investment grade.
Oh, so high yield and income corporate bonds are the junk bonds.
That's right. And they may not necessarily be terrible, but what that means is you're getting a company that doesn't have good as a credit score. And just like you and I, if they don't have good as a credit score, they have to pay higher interest on their debt.
I see.
So hence high yield.
So it's a risk because the company could like default on that or something?
Yeah, that's possible. Okay. Sure. And if they default, there is a payout schedule, lots of things that happen, and debts are paid before shareholders.
Okay.
This is just a great way to look at exposure if you just want the treasuries, and this is by risk scale. So treasuries, that's right. That's why I like this setup.
Okay. Yeah. When we look at the first column, year, so this is like so if it says 2024 and then we're looking at the U.S. Treasury and it says IBTE, so that's in
it's like 6 months.
Bond for like the rest of 2024 basically.
Yep.
Okay.
So that'd be about 6 months. So maybe we look at IBTE and I'll pull up fidelity.com. I'm actually logged in and I'll share my screen if you want.
Okay.
Why not? What did I say? IBTE? Let's analyze a fund.
Yeah. It's a tool.
So on the overview, we can see price, where it's at. So reasonably $23.91 a share. Oh. When I am looking at an ETF, we want to look at tracking error and expense ratio. Right. This has a pretty high tracking error.
What does tracking error mean?
If you have an ETF that's supposed to mirror the S&P 500, this would deviate from its benchmark 7%.
Okay.
It's not doing what it's saying it's doing.
Right.
It's a liar.
It should be closer to 0%, right?
Yeah, but there is supply and demand, so that happens, which causes turnover. 7's really high, so I find that interesting. But 5% yield, so we're looking at something with a yield, so that's going to lock in our 5%. That makes sense, right?
Yeah.
And the top 10 holdings you can see is Treasury notes and their yields.
So this is a fund of 10 different like T-notes basically from the US T-notes.
Well, this is telling us the top 10 holdings. It has 22 altogether, so we could actually pull it all.
Mm-hmm. So this fund that's like it was like $23 a share, is comprised of 22
Treasury notes.
Treasury notes. Okay.
That's right. And that's what's giving us the 5% yield. Distributions and expenses. When does it pay us out? It pays us quarterly.
You have to hold on to this ETF for that set amount of time?
No. So the way that you qualify for a dividend, you have to own it the day before the X date.
Oh, okay.
So if I owned this on June 2nd, I would have qualified, had to hold it overnight, and then I would get paid on June 6th.
Is that a workaround weird tactic strategy to like get more money?
People think that, and what happens is the very next day it trades without the dividend. Oh. So it's reduced by that amount. Oh. So don't try to play that game. Okay. People ask that all the time.
Well, good to know.
It's very, very keen observation, and I am impressed. Nonetheless. But yeah, here's the distribution schedule and what is important to know with these different type of things. I say what's important to know all the time. Everything's important, guys.
Yeah.
Bonds and their yield have an inverse relationship. We explained this on the inverted yield curve episode, meaning when the yield goes up, the price goes down.
Right.
You're going to see price fluctuation in this. So if yields go down, which are anticipated, the price of these are going to go up. So you'll still get some capital appreciation in that as well.
I see. So that's why it's a good time to potentially look at buying these now while the prices are down.
That's right. So now they've already reacted to data, though. And if there's more data, though, that's going to come in. But it's still a method for you to lock in rates because they already have those securities that are there. Meaning you're going to go lock in that rate. Or if you were going to go buy a treasury now, you would have it probably at a slightly lower rate, or we could even look. But then you would see if all of a sudden rates were going to come down, you'd see the price of that go up. So the same thing would happen no matter what, is what I'm trying to say. It's not like these have bought securities that are within that portfolio and you can buy into it. You're just going to might buy it at a different price.
So what would be the difference here between buying some shares of a Bond ETF versus just like putting a bigger amount of money into buying a T-note? Like it's the difference is this bond is comprised of multiple, so you get access.
Yeah, that's a great question. So this one has 22 different T-notes inside of it. So 22 altogether. So you're going to get diversification. You're also going to get a little more liquidity, meaning when you have that T-note, you're expected to hold that into maturity to realize its full value. Whereas with this, it's going to do that within the fund itself, but because it's an ETF, it's going to trade like a stock. So it's taking items from the bond market and putting them on stock market because it's going to trade on the secondary market. ETFs trade just like stocks.
And the money you're getting back, like this is a dividend ETF, not a growth necessarily.
This is not growth. This is income. Okay. So this is a method for cash that you don't intend to utilize within the next 6 months or so.
Okay. So basically, if we know the Fed, or we can see the Fed is projecting to do a rate cut soon, that means the yield curve will go back to being de-inverted. And then the rates of T-note, like bonds and treasuries and things, will drop just like our high yield savings account interest rate will drop. And the stock market, like the bond market and the stock market kind of do opposite things, right?
When you're thinking about risk on, risk off, money always goes somewhere. And it's where does the money go? So if people are selling off stocks and then going into bonds, but if they're going into both, that can happen too.
I see. So people might be holding on to their stock market portfolio, whether that's like stocks or ETFs or whatever, mutual funds, but also investing in bonds now because they know that those rates are going to come down. And so like both markets can be successful at the same time until there's like a big enough economic shift. Like
and then they just have different risks. It's all about portfolio diversification.
Yeah.
So you are just like the way that target date funds work. There's the fixed income side, and then there's the equity side. And then within the equity, there's a risk scale too, but it's rotation. The point is, if you have a ton of money in a high yield savings account and you have been banking on that 5% and it's well above your emergency fund needs, you need to do something with that.
Right.
And this is a solution. So put it into some treasuries.
Solution.
Right. You're going to lock it up. So you're going to increase the risk, but ever so slightly.
Yeah. And still get the same, hopefully the same kind of returns back you've been getting.
Exactly. Now, to guarantee that, lock that up. You can even look at CDs. And remember, there's brokerage CDs like we discussed. So you can look at our CD laddering episode. Super relevant. Will be linked in the show notes. That's really it. Nothing crazy.
So if we want to look
or
at
is it?
No, I mean, if we want to look at different bond ETFs, you can look at your brokerage firm or any brokerage firm, the one that you use, and see what they have. You can put this in one of the tools we've mentioned in past episodes, something like Fund Story we've mentioned before, or whatever tool your brokerage firm might have to compare different bond funds. You can look at them all and decide if that's the right move for you, or if you just want to do a CD ladder or a CD or a straight up buy the bonds, the treasury notes themselves from like treasury.gov.
Yeah. And normally you can do the treasury notes with your brokerage firm even too.
Yeah.
You don't have to go to treasury.gov.
This is just a way to see all of your options.
All of them.
And diversify. You might buy a little bit of each.
Yeah. Exactly. That's it.
That's it. Bond funds. They exist.
They do. I like the way that was put. It's beautiful.
And then we also will link the ratings guide. We're going to link the things in the show notes. We'll have it on the website. You can always ask us your questions.
You can.
Well, you heard it here, Money Coven. Take a look at those bond funds and tell us what your strategy is, or ask us your questions.
Yes, you know where to find us. And please show up for us. We show up for you with all this free education. Leave us a review. That rhymes. Or a star rating. If you have not already, it helps us spread the word.
The good Finlit word.
That's right.
Until next time, keep learning, keep earning, and keep breaking those barriers.
Ding, 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 ding.
Remember, investing involves risk. There is always potential to lose money when investing in securities. MakeHer provides educational content and resources for informational purposes only. We are not registered financial advisors and do not provide personalized investment advice. Any information provided by MakeHer on our website or podcast is not intended to be a substitute for professional financial advice. MakeHer is not liable for any investment decisions made based on our content.